The world's not coming to an end just because NVIDIA had a bad day. Today is January 27th. Markets are closing. The expectation we had about a late January high is still the case. And we do expect that even though it had a sharp decline today, the S&P will probably rebound later in the week after the 29th into the early part of February, which was a possibility based upon the 147-week cycle and the 54-week cycle multiples and all the things we've been saying over and over again. That January would have a strong rally. It did. February is going to go down. It hasn't happened yet. This may or may not be the beginning of it, but even if it is, it's probably going to rebound some anyway, because this is a topping pattern that will probably be formed before it's ready to really fall. And that could last until as late as February 5th, believe it or not. Okay? So this is primarily a video for swing traders. We talk a little bit about the day trading, but it's not our emphasis. And the primary story here is that for the Elliot wave people, if you look at the market rally that just started on January 13th and ended on Friday, it has 5 waves in it. But the 5th wave is an extended 5th wave. And extended 5th waves are kind of stretched. And after they finish their rally phase, the market will tend to correct back down to the region of the extension. And that was a pretty big distance away. And that's what happened this morning. Okay, NVIDIA fell right back down into that region. If you're familiar with the Andrews median line system, the market corrected exactly to the median line, which would have been the projected low. Didn't have to happen this quickly, but it did. It also shows the market's not as strong as it looks, right? Those people who are super bullish. It undid almost half of what it had done in 3 weeks. It did it in 1 hour. So, the market still is not in a stable or strong or an undoubtedly bullish mode at the moment. So our thinking is basically we're looking for a high coming in, which may have happened, but should be retested minimally, and possibly we'll even see higher prices by February 5th. And then it goes down hard in February. Okay? We're looking for a low between the 3rd and the 10th of March, our first low. And then after that, it might rally strongly again in March. So it's a very volatile and very extreme type of market where a slight trigger can cause huge changes. And so you need to protect your positions, whatever you do, one way or the other. You have to either hedge your positions or have some sort of stops in every trade that you make. The Dow is up today. You know that. All these tech stocks and the NASDAQ and such, they were nailed, but the Dow was up, okay, because it didn't have any of those stocks in it, right? And the Dow is a very stable. And if you're going to be trading in a bear market, you might want to consider moving money into Dow stocks because they tend to do better in bad market conditions. The other thing I wanted to point out is that we look at some of the astrological things, and what's interesting is the position of Mars right at the moment is debilitated. Mars is supposed to be related to technology. Debilitated Mars is not good for the technology stocks, and that's, of course, who got nailed. Because Mars is debilitated, when the moon runs into Mars every month, happens once a month, it turns out the last 6-7 months, the market has had highs exactly on those points. And the market falls dramatically. Oftentimes, very within an hour or so, it goes down, sometimes for a day or two. The trend has been up, so those declines don't last long. But it's interesting, and you can see in this chart, the last 4 or 5 months, that the market fell directly down as soon as Mars ran into the moon on that moment that it happened. The next time it happens is on February 2nd. So that might be another high point before a sharp follow-through on the downside. The other thing I wanted to point out is that if you look at the patterns of this Moon-Mars conjunction, when Mars is in the sign of Cancer and the Moon is in the sign of Cancer with it in the sidereal zodiac, and you go back of all the times in the prior history of the S&P back to 1998, most of them are not a good match to this year. But there was one pattern. It was actually September 1st of 2013 lines up with January 13th of 2025. It's an 11-year and 4-month cycle. And that cycle has been repeating with a very high correlation, even on an hourly, back for the last 6 months, and you can see that picture. And if you go back 15,000 hours, it turns out an 11.25-year cycle has been repeating at a 95% level of correlation. And has been, in other words, it's been repeating for a really long time. The other thing that's very interesting is that we had mentioned 3 or 4 weeks ago that there's a Venus-Saturn conjunction that's been going on for a few weeks, and that historically that has a tendency to be somewhat bearish. The exact date was the 20th when they came together, and 3 cycles of that comes out almost exactly the same as the 147-week pattern, and it called for a high immediately. It called for a high like the next trading day, and ultimately it seems to be correct. So the most recent occurrence you can see in this pattern, and the 3 times ago occurrence you can see in this other chart, and they both basically go down into late February, or at least early March potentially, before any resumption of any strength. All right, but remember, the market is not necessarily collapsing at this moment. It's a little bit early, and that you need to be very alert because the volatility is going to continue to increase probably all the way until May. All right, we're not looking for more than a 10% break. We're not looking for a crash, but we could see somewhere between 10 and a little bit maybe larger than that between now and the early part of May. And we may have seen the start of it, but I'm thinking probably not, and that it's likely to have one more pop back up into early February before it's ready. And that's our update.